let's talk about investing. For anyone who's ever felt completely overwhelmed by all the financial news out there, we want to offer a clear, straightforward path forward.
You know how it is. One day you hear that you should be buying gold, and the very next you hear you should avoid tech stocks. All that conflicting advice can make it feel totally impossible to know what to do. So here, we're going to explore a really solid, time-tested strategy for building wealth over the long run.
So, here's our roadmap. We'll kick things off with why investing is so important in the first place. Then, we'll pull back the curtain on how the stock market actually works. After that, we'll dive into a powerful tool called an index fund, show you exactly how to get started, and finally wrap up with how to manage risk and, most importantly, stay the course.
All right, let's start with a really fundamental question. Why not just keep your money in a savings account? I mean, it seems safe, right? Well, as it turns out, doing nothing actually has a pretty significant and often hidden cost. The first reason is a little thing called inflation. Now, in simple terms, this just means that as prices for everything, from your groceries to your gas, go up, the cash you have buys less than it did before. Your money is slowly but surely losing its buying power.
So even though a savings account feels like the safest place for your money, inflation is constantly chipping away at its value. It's like a slow leak. You're guaranteed to lose purchasing power, even if the number in your account stays the same.
And here's the second big reason. In our economy, there's a huge difference between earning a salary and owning an asset, like a piece of a company. You see, historically, salaries have had a really tough time even keeping up with inflation. But owning assets, that has been the #1 way people have built real, lasting wealth.
Okay, so if owning assets is the key, how do you actually do it? Well, this brings us to the stock market. And I know it can sound intimidating, but at its heart, it's just a big marketplace, and it's a lot less complex than you might think.
When you buy a share of a company, let's say a share of Netflix, you are literally buying a tiny, tiny piece of that business. You become a part owner. What you're really doing is placing a bet that Netflix is going to keep growing and become even more valuable in the future.
So how does this ownership actually make you money? Well, there are two main ways. The first is what we call capital gains. You buy a share for $100 and later you sell it for $150. That $50 difference, that's your profit. The second way is through dividends, which is when a company takes some of its profits and just hands them out directly to its owners, the shareholders.
Now, you could spend your time trying to pick the next Amazon or the next Google, but let's be honest, that carries a huge risk of picking the wrong one. This brings us to a much safer and often way more effective strategy, one that means you don't have to pick individual winners at all.
Just think about the story of BlackBerry. Back in 2008, this company seemed completely unstoppable. Its stock was trading at $144 a share, and today, that same share is worth around $4.50. It's a perfect, if painful, reminder of how risky it can be to bet on just one single company.
And here's the crucial takeaway. Even for the experts, trying to predict which companies are going to be on top in 10 or 20 years is incredibly difficult. Today's giants can easily become tomorrow's struggles. Trying to pick individual stocks is a really, really tough game to play. So, instead of trying to find that one needle in the haystack, what if you could just buy the entire haystack? Well, that's exactly what an index fund does. It's one single investment that holds a whole basket of stocks, letting you own a small piece of the entire market with just one click. A classic example is an S&P 500 index fund. This one tracks the 500 biggest public companies in the US. By owning it, you get instant diversification across hundreds of different businesses. And historically, the average annual return for the S&P 500 has been right around 10%. You're basically betting on the long-term growth of the economy as a whole, not just one company. And this table really shows you why that's so smart. Just look at how the top companies change over time. The market leaders back in the 80s are totally different from the tech giants that run the show today. The beauty of an index fund is that it automatically adjusts for you, selling off the declining companies and buying the new rising stars.
All right, so the theory is solid, but how do you actually put it into practice? Let's walk through a simple 4-step process to get you started on your investing journey.
First, you pick an investment platform, an app or a website. Just make sure it's properly regulated and has low fees. Second, you link your bank account and add some funds. Third, you choose your investment. And as we've been talking about, a broad index fund is a fantastic place to start. And finally, the most important step of all, you automate everything.
This automation uses a really powerful strategy called dollar cost averaging. All it means is that you invest a fixed amount of money, say $100, on a regular schedule.
When you do this, you automatically buy more shares when prices are low and fewer when they're high. Over time, this smooths everything out and completely removes the temptation to try and time the market.
Now let's talk about that one big fear every new investor has. What happens when the market goes down? This section is all about the psychology of investing and how to manage the real risks involved. It's the number one question, isn't it? What if I finally get the courage to invest and the market crashes the very next day? It's a totally valid thing to worry about.
But here's the truth. For most of us who are in it for the long haul, the biggest risk isn't a market crash. It's our own reaction to the crash. Seeing scary headlines and panic selling your investments is often what does the real damage, locking in your losses for good.
And this is exactly why that fourth step, automation, is so powerful. It's your secret weapon against your own worst instincts. It takes emotion completely out of the picture. It stops you from panic selling, builds a great habit, and makes sure you invest consistently. And that consistency is the real key to success.
Look, at the end of the day, no one has a crystal ball that can predict what the market will do tomorrow. The goal isn't to guess the future, it's to build a solid plan that's ready for whatever the future brings. So, the real question to ask yourself is this: are you actually building a plan, or are you just crossing your fingers and hoping for the best?